Welcome. This is an interview of Brady, the co-founder and CEO of Bonzo Finance Labs. We're going to learn all about how borrow-lend protocols work, how Bonzo has become the liquidity layer of Hedera, and then future features on their roadmap. Learn all about Bonzo today. Disclaimer. The views in this interview are personal and not official Bonzo Finance advice. Any forward-looking statements about Bonzo Finance and its associated projects involve risks and uncertainties. Please do your own research and consult a professional before making any investment decisions. Bonzo Finance and the speakers on this interview today are not liable for any actions taken based on the information provided. I thought what we talked about originally was to go over all of Bonzo and how the company started and all of that. But then due to, like recent events, I think what I saw on X and social media places, a lot of people didn't seem to understand really just what a borrow-lend protocol is, not just Bonzo, but in general. So let's talk about that and then go through the liquidation, how that works and everything. But could you start by talking about, what exactly is a liquidity layer and a borrow-lend protocol in general?
Yeah, absolutely. And really appreciate you having me on. So my name is Brady Gentile. I'm the co-founder and CEO at Bonzo Finance Labs. We're a development shop that contributes to the development of the open source non-custodial lending protocol Bonzo Finance on the Hedera network. The protocol is based on Aave v2 with adaptations that have been made to ensure that it works on the Hedera network. So Hedera's EVM and native token service for tokenized assets within the protocol. Bonzo Finance is positioned as the liquidity layer of Hedera, as you mentioned. And what we mean by that is, Bonzo Finance is serving this purpose of offering lending and borrowing, decentralized lending and borrowing for users within the ecosystem for various assets that exist within the Hedera ecosystem. But ultimately, a lending and borrowing protocol can act as a foundational layer of liquidity for other types of advanced protocols that exist on top of it. So oftentimes within DeFi ecosystems, you see like perpetuals markets where its functionality is utilizing things from the lending protocol, the primary lending protocol's functionality. Or maybe it's index tokens or derivatives or various advanced DeFi protocols. They'll integrate into the lending protocol. And so we see from the lending protocol's perspective, it being this layer of liquidity, but also it opens up the door to Bonzo Finance as a protocol extending its abilities beyond just lending and borrowing into things like liquidity vaults, which is a product that's being launched within the next couple months. Vaults are essentially automatic.
Wait. Okay, hold on. That all makes total sense. Pretend for a second that there's a bunch of people sitting in the room that look like me and they're not all that bright. Everything you said made sense, but that's because I've been paying attention to Bonzo for like 6 months. So let's go back to the very first thing you said, open source, non-custodial. So we've got the Bonzo website. You go there, there's assets you can put in. So can you just explain in general for someone who has no idea, what is the open source and what does the non-custodial mean?
Yeah, I can definitely do that. Good call. So Bonzo Finance is an open source non-custodial lending protocol that's based on Aave v2. And I know that's a loaded phrase. Open source being that it can be contributed to by any developer in the ecosystem. It exists in an open format on GitHub. It could be forked. Essentially, people can copy and modify it. And non-custodial being that it is assets that are custodied by the end user. So, Bonzo Finance Labs acting as a contributor to the development of this protocol, while it helps with the development and configuration and deployment. The labs organization, for example, and any other organization or individual can't actually touch the funds inside of the protocol, unless it is the user that supplied those funds to the protocol. So Non-custodial being there's no sort of a custody of assets or management of those assets by a custodian.
Okay, that makes total sense. And you mentioned the Aave. So correct me if I'm wrong. Aave has been around, I think, since like 2017 or something. May have gone live around like, let's say, I don't know, 5 years ago. So Aave is a huge borrow lend protocol built on Ethereum with billions of dollars. And essentially, you've taken that and you're using it and modified it such that it would work on the Hedera layer.
That's right. Yeah, Aave is arguably the top lending protocol across Web3 today. It is an open source protocol. It's been around for a while. It's been battle tested, economically and technically. And in particular, its Aave v2 instance has been around for some time. And so, when it comes to trying to figure out, choose, modify, deploy a protocol that brings this kind of credit markets functionality to the Hedera economy, it made sense to choose one that has been the most battle tested.
Sure.
That's not to say that there can't be issues with the protocol. At the end of the day, it is based on smart contracts, and while it has been audited by Halborn and secondary audits are being performed right now, the DeFi is always risky in general. So just
Yeah.
wanted to put that out there. Yeah.
I think that's interesting from a user standpoint, like a mainly, I mean, I've got some technical background, but from a user who wants to put money on this platform, correct me if I'm wrong, I look at it in two ways. One, I say the fact that you're using that Aave is a huge bonus. You're not building something from scratch. There may be billions in Aave and there may be 100 million in Bonzo. That has nothing to do with is Bonzo not as good as Aave? No, it's exactly the same. It's just on a different layer. So for a user, that tells me security. I know that this is a battle tested code base. It's not going to have problems. And if it does, probably the same problems Aave would have had. So I don't see that as a risky thing. I think that's a lot. People looking at it in a vacuum would say if there's not a lot of TVL compared to something else, therefore it's not that great. That's not the case. And non-custodial to me, having been through two of those bankrupt companies where I put money in, like BlockFi, and later I got a small percentage back. Non-custodial basically means if, like with Coinbase or something, if it's a Coinbase exchange, they have my assets, it's on their balance sheet. If they go bankrupt, those assets are being held. If it's non-custodial, it's not on their balance sheet, like the Coinbase wallet in this case. So the fact that Bonzo is non-custodial, I think that's a big deal. I just wanted to point that out because, I mean, now correct me if I'm wrong. To me, that says security and safety.
Yeah, you're absolutely right, and I think that's like the promise of decentralized architectures. Is you mentioned BlockFi. There was Celsius, there was FTX. We've
I
gone
know
through.
Celsius as well.
uh,
Unfortunately.
I was going to say hopefully not too unfortunately, but yeah. And I think that's the thing is the transparency of a protocol that exists on chain. You can see all of the transactions. You can verify that the amount of funds that are displayed on a UI actually exist within the underlying asset pools within the protocol. The non-custodial nature of it, where no individual actor or group of actors can is able to touch the funds that are in the protocol. All of that is sort of the promise of these decentralized architectures where, oftentimes, like for the example of FTX, they were able to take user funds and have Alameda be able to use them for various like investment purposes where, that could and did in that case end up resulting in negative consequences for the people who supplied those assets into FTX. And so, this is really it's a removal of intermediaries, the promise of Web3 and these protocols, and so definitely aligns to that. And then I think to your point with regards to just looking at the safety with regards to Aave, like yes, from a functional perspective, that battle tested nature of it goes a long way. Part of it, and this is I think what we'll dive into today, is around and not just the code base itself, but also the way in which all of the parameters of the code base are configured. There's a number of different parameters that are set per each asset pool within the protocol. And those parameters do help determine risk and safety of the protocol. And I know we'll dive into a little bit of that later.
Yeah, let's talk about that now. So, and I'm glad you said that when you said it takes out intermediaries. Because to me, from why I love DeFi so much and the whole debanking is the idea that I have complete and total control. Because this is all, like you said, it's in a code base through smart contracts and whatnot. There isn't a person at a desk denying what I can and can't do like you would have at a bank. No one's pulling a credit report. These are over collateralized. But so let's start from the basics of the lending protocol. I can supply assets. I can hook up my wallet. I can put in some Hedera, anything in that list, Sauce, you name it, Bonzo. And then I can also take out like USDC or other crypto. And to your point, can you talk a little bit about loan to value and then liquidation and those two thresholds, what they mean?
Yeah, absolutely. Yeah, these are critical parameters within the protocol on a per asset basis that determine the sort of risk and the capabilities for the end user for those assets and pools. So what loan to value is again, these are over collateralized loans. So that means you have to supply an asset into the protocol, and then you can borrow up to a certain percentage of value against that asset in the form of any other asset that is supported by the protocol. And loan to value is what that percentage of value is. So if I were to supply $100 of USDC and the USDC asset is configured with a loan to value ratio of 80%, then that means I can borrow up to 80% of the value that I supplied in USDC. So I'd be able to borrow up to $80 worth in this example of any of the other supported assets. The question then becomes is, let's say I borrow a volatile asset against USDC. So I borrow HBAR. And HBAR's price fluctuates. So if I were to borrow, my maximum LTV against USDC, and I borrow it at one point in time $80 worth of HBAR, and the price of HBAR starts to rise, I am in real time borrowing beyond my loan to value. So let's say it goes up and it's worth $85. So now I've supplied $100 worth of USDC. I'm borrowing $85 worth of HBAR because the price rose. At a certain point, the value of HBAR, if it were to continue to go up, would exceed the amount of collateral that I supplied. And just like in traditional finance, when that takes place, oftentimes it's called a margin call, or in the instance of a decentralized lending protocol, a liquidation. And there is a parameter that's set beyond the loan to value ratio called a liquidation threshold. And let's say again for this example, the loan to value ratio is 80%. Maybe the liquidation threshold is 90%. Once the value of that HBAR that I borrowed exceeds that liquidation threshold of 90%, that is when there is the ability for a liquidation to take place against the USDC that I supplied as collateral, in order to ensure that suppliers of that collateral remain solvent. Oh, sorry, the suppliers of that debt remain solvent. So suppliers of HBAR that you're borrowing.
If someone comes and they put in, let's say, Hedera, like myself, I put in 10,000 tokens, it's worth 10 cents, I put in $1,000 worth. So I take out, let's say, a stable coin USDC, and I can take out loan to value 70%. Now, the Hedera token all of a sudden goes down in value. So now it's not worth 1,000, it's worth 900, it's worth 800. So can you talk about that threshold and what happens at the point where those two come closer?
Yeah, so you're absolutely right. the first example we gave was talking about supplying like USDC and borrowing HBAR, and then the price of HBAR fluctuating. And then in this example, it's supplying a volatile asset as collateral and then borrowing a stable asset, and the price of the collateral changing, which also has an effect on the loan to value ratio. It's the ratio of the two, or if you have multiple assets, a combination of the ratios.
Right.
So, in this example, the price of, let's say the price of HBAR starts to go down. What it's doing is reducing your borrow power in the denomination of US dollars. That has the same effect as if you were borrowing a volatile asset and the price were to be going up. And it's that LTV and liquidation threshold that is effectively driving the overall risk of the position. The loan to value ratio being the maximum that can be borrowed relative to what is supplied. And then the liquidation threshold being the buffer between the maximum that can be borrowed to the point at which the collateral supplied can be have a propensity to be liquidated.
Okay. And the whole point of this is it's essentially such that these are over collateralized loans. And the idea is just like a margin loan with stocks. When the threshold becomes closer, you need to liquidate to make sure that the borrower, can actually pay back that loan. Because if that doesn't happen, it's putting the protocol at risk because now we've got someone defaulting. And by using these thresholds, correct me if I'm wrong, there's never really a default. And well, there's never really a negative. A borrower can't get away with not paying a loan, which is another benefit of using a platform like this. If I think of myself as loaning out money to other people, I will always get paid back. Would that be a true statement?
That is accurate. There is an instance, and this is something that happens over time across most decentralized lending protocols, whereby if liquidations, these margin calls, don't take place to ensure that suppliers of assets, creditors, remain solvent, there can be an accumulation of bad debt. Mm-hmm. So on other networks, that Aave operates on, let's say Ethereum, that have extreme variability in transaction fees, for example, when there's small positions that essentially go bad, the transaction fees could potentially prevent a liquidation bot from performing that liquidation. And because it's not economically viable, so that results in bad debt for the protocol, that if you have enough of these small positions that aren't liquidated, it accumulates over time. And we see that in Aave on Ethereum and some other networks, especially ones where transaction fees are both volatile and not fixed. One of the benefits actually with Hedera is that the transaction fees are both small and they're fixed. And so the economic viability for liquidations to take place is very strong, even for small positions. So there's been hundreds of liquidations that have taken place in Bonzo Finance on the Hedera network. And because of the low cost of those transactions, all of them have been economically viable for liquidation bots. And so there has not historically been this accumulation of small bad debts over time. One thing that works, I guess, for this instance of smaller positions that become uncollateralized, if an asset's price drops very quickly and it is being used as collateral and causes more of a cascade, or it's a very sharp drop, there is the chance for bad debt to accumulate in the protocol because of the speed at which it dropped and the ability for liquidation bots to perform those liquidations in an adequate amount of time. And
Okay.
so, we did see that with this recent event. There was a small amount of bad debt that was accumulated in the protocol, which is covered by the protocol's treasury. So it does not affect, continued operations and something that's actively managed. So totally in the clear with regards to that aspect of it.
Okay, that brings up a good point. So let's split that into two things. So if we back up a little bit, once we get, because what you said made complete sense, but let's unpack it. When we go back to, let's say that I'm now being liquidated. You brought up a good point, which some people may not realize. The protocol itself isn't performing a liquidation. So in order to get what you call that bad debt, the reason that occurs is because there are third parties that create these liquidation bots that
Yep.
perform the liquidation. And they're incentivized to perform the liquidation because on Bonzo, it shows that there's in that buffer, they get a small fee for performing the liquidation. Can you explain how that works, how the bots take care of this, and why we would care as a user?
Yeah, absolutely. So far we've covered the loan to value ratio and the
Mhm.
liquidation threshold for these markets. This next parameter that we're covering is what's called a liquidation bonus,
Yep.
or otherwise sometimes called a liquidation penalty. And that is another parameter that's set, whereby depending on the attributes of the asset that's being used as collateral, this bonus is configured as a percentage. So let's say for an asset like USDC, where it's of a reasonably large amount of liquidity on secondary liquidity markets like a saucer swap, and it is of stable value, that liquidation bonus is going to be smaller relative to maybe other volatile assets, and that bonus is essentially a discount that liquidation bots are able to seize collateral of. So if, obviously USDC is pegged to a dollar, if the liquidation bonus is 4%, they would be able to purchase the collateral from the position for a 4% discount as long as they repay the loan that is being used against the USDC that was supplied. So liquidation bot repays the loan and then seizes the collateral at a discount, and that's sort of the incentive model for these bots to continue to keep the protocol healthy.
Okay, so the bot is doing two things. One, it's paying back, and I believe it's up to 50% of what I owe. So in other words, I'm not being completely liquidated. They're just bringing down the percentage so that I'm still in compliance, and there's
Yep.
no fear of me not paying. So the bot says, "All right, I'm going to pay back that turkey's loan because he's not doing it, and then I'm going to go grab some of his assets so that I can cover what I just paid back." Is
Correct.
that correct?
Yeah, and only the assets that have been supplied to the protocol as collateral. Yes.
Now, from there, let's talk about, you said, the bad debts that could accumulate. And I think what your point was, hey, some of these bots, they're not just doing this out of the goodness of their heart. They're going to make a little bit of money. They're going to make a percentage of what's being liquidated. So that's why they're going to do it. If they're not going to make any money because the fees are so high, like on an Aave platform, then they're not going to perform a liquidation, and now we have a problem. But on Bonzo and Hedera, the fees are so low, it's almost always economically viable, even with a small debt, for the liquidation bots to do what they do.
Correct. Yeah,
Okay.
there's a stronger degree of economic viability due to the transaction fees being fixed and low to allow for liquidation of even very small positions, which is really great. That has helped keep the protocol healthy over time.
Yeah. All right. Let's talk about the recent one that was big. But first, you said, and I like the way you marketed that. You called it what? A liquidation penalty or liquidation bonus? I think I would go with liquidation bonus. That sounds much better.
The bonus is stronger on the marketing front. It has
Yeah,
to do with the perspective, though, I think.
of
So
course.
as a liquidation bot, it's a
Yeah.
bonus, but then as the person who has supplied the collateral and has defaulted, for them it is a penalty. Yeah.
Yeah, no, of course. And not to laugh about liquidations. It stinks if you're getting liquidated and this happens. But the one that was the recent liquidation, and the reason I wanted to reach out to you and talk about this was we saw that, in my opinion, a lot of people didn't realize what was happening when that Bonzo price happened to drop quite a bit. Because as you've said, liquidations have been taking place on the Bonzo platform. This was a fairly unique incident that had a large amount. And I'll let you speak to it. But from my mind, it was there's so much being sold and there's not a lot of liquidity to match it. And therefore, the price kind of cascaded down and could potentially cause other liquidations. So can you talk a little bit about that large event? I saw that, and we'll put a link to your post, because that was a really good blog post where you walk through step. And by the way, it's very impressive that you all come out with such transparency and literally, like, you wrote a blog post explaining exactly what happened when a lot of other protocols would not have taken the time to do that. So can you talk about that particular incident?
Yeah, absolutely. And I appreciate the kind words on that. Trying to stay as transparent as possible with, with the community and all stakeholders is super important.
Great.
And trying to document what happened, not only for our own knowledge on it, but also just sharing amongst everybody in the ecosystem. So the Bonzo Finance protocol pretty quickly has been able to achieve a strong amount of liquidity and utilization, and that's great. It shows that there is a strong DeFi ecosystem. It shows that there is a desire for credit market capabilities within the DeFi ecosystem on Hedera. This protocol offers new types of functionalities for users, and with the growth that was seen, I think what's been determined is at a certain threshold, a update to some of the parameters within the protocol was warranted. And this is just to ensure that the protocol is able to continue scaling safely. It sort of reached a limit on its abilities, and at that point, you have to say, okay, is there are there adjustments that can be made that allow the protocol to continue on its path, continue to provide utility to users, but also ensure that the ecosystem continues to remain safe, and users are able to remain safe. And I think at the core of it, lending protocols, they sort of live and die in terms of stablecoin liquidity. When you look at lending protocols across Web3, stablecoin liquidity is arguably the most important sort of asset and markets that exist within them, because most users, in terms of the types of activities, stablecoins allow for a larger variety of activities that they can do, or strategies that they can do. Stablecoins also bring a lot of safety to the protocol, given just their stable nature of being pegged to a fiat currency. And so, with this event that took place, it was the ability for users to be able to utilize these functionalities. It appears that there was extra sort of flexibility for that in terms of their ability to supply certain assets as collateral, being able to borrow against them. And so, as part of the change process to allow the protocol to continue on its path, having an independent ecosystem risk steward be the authors of and supporting these parameter and risk aspects of the protocol through the authorship of change memos. And upon instantiation of the DAO, those change memos are proposals that get voted on by the community. And so this process that's been implemented is sort of the standard practice that we see across the maturest lending protocols in the space, Aave, Compound, et cetera, where there are these risk stewards that perform deep analysis on not just the protocol, but also the ecosystem and its assets. And they propose the changes to the protocol in order to keep things safe while still offering users the flexibility of being able to take on the risk that they assess and actually use the protocol. I think it's a balance between those two things.
Okay, so if I was sitting at the table listening to you and I was a venture capitalist, I would say, I'm going to invest, but I have no idea what you just said. But I do understand what you said. So let's unpack it. Basically, if we take it like there's about three different things you were talking about. One, if I'm just coming in and taking a stable coin, that's just basic everyday activity. But there are strategies people can employ that become riskier and riskier because they can over leverage. For an example, I might put in some HBAR, take out some USDC. That's a typical. Then I take the USDC, I go over to Saucer Swap, I buy a bunch of HBAR, I come back and I put it in. Then I take out more USDC and I go buy and I just keep doing this. And at some point I have to stop. But that becomes a riskier activity. And that may have been part of what caused, the recent cascading of, being liquidated because of a pretty large liquidation. So you all said, okay, what can we do to sort of mitigate some of those strategies or keep those from being too risky because they can affect the entire protocol if there's an issue. And to do that, you've been able to use an outside firm who specializes in auditing and determining risk. And then they made the proposal as to here's what you should do. And why don't you, if you could, if tell me if that's right or wrong. And then I think that leads into caps.
Right. So there was a risk firm that historically has been used since the beginning of instantiation of the protocol. The capabilities of that was to allow for safety up to the point at which we've seen the protocol achieve. And a standard sort of maturation process for the protocol and in support of establishment of the DAO calls for a independent ecosystem risk steward that is taking on greater roles, a greater role with regards to this risk aspect. And that includes sort of, as described before, authorship of these change memos, justification, voting when those proposals go live within the DAO once instantiated. And so, at a baseline, additional caps that have been added from the supply and borrow side.
Okay, explain that.
Yeah, so caps on asset markets are the ability for the protocol to limit the amount of liquidity on a per asset basis that can be supplied to it or that can be borrowed from it. And so the configurations are each market has a supply cap and a borrow cap. And so far we've talked we've talked loan to value ratios, liquidation thresholds, this liquidation bonus or liquidation penalty, depending on how you look at it.
Yeah, bonus.
And then and now there's supply and borrow caps. And supply and borrow caps are this additional set of parameters that work in conjunction with the other parameters to restrict certain thresholds within the protocol of supplying and borrowing. And so in combination, they work together to try and ensure safety of not only the protocol and its users, but also the assets that are in the protocol and supported by it and their projects.
So from a user perspective, I go in and I say, I want to put in 500,000 Bonzo tokens, and it says, nope, you can only put in 200,000 because it's capped. That's capped on a per asset basis, per user, per asset per user.
It's capped on a global basis. So it's a cap that's set based on not per user, but for the entirety of the pool itself.
That would make sense because I had put in some and it said I was capped out. And a couple days later, I tried to put some in and it allowed me. And I thought, well, that's interesting. Someone must have pulled some out and I was able to take that spot.
Exactly. Yeah. And the way that I guess the sort of methodology behind that is, there's a number of there's a number of variables that go into determining what those caps should be. But a big one is, assessing the risk based on the amount of secondary liquidity and the concentration of that liquidity for the asset. And so, those caps are set based on an analysis of that as like a primary variable. And then there are a number of other variables as well that's factored in.
So based on what you just said there, that event we had, Bonzo had recently where an individual was liquidated and they had quite a bit. And so some of their assets were taken and they were being sold very quickly. And I saw on social media, people were saying, oh, something was hacked. Someone's selling a whole bunch. And it was literally just this bot claiming some assets to sell them after it had paid back some of this person's debt. And because of the liquidity, the price was dropping because it was selling so much. And I guess what you're saying is with these caps, you're trying to keep that from happening because one of the variables this firm's looking at in terms of assessing the risk is how much liquidity is out there for certain assets. If we cap it, that event's less likely to happen in the future.
Correct. Yeah. And it's limiting the amount that can, it's limiting the global amount that has the propensity to be liquidated and then subsequently sold in order to sort of in order for the liquidation bot, I guess, to realize the bonus that it would be receiving. Yeah.
Oh, okay. That's brilliant. I didn't put two and two together there. That makes sense. Oh, two more things to talk about. One I forgot, which was, can you explain when we talked about loan to value and then liquidation? And recently you all just made a quick change, which was you said, all right, if I put in a certain amount of Bonzo, I can take 50% against it. And that went down to say 30%. So loan to value changed. And I was thinking to myself, oh, that means I'm going to be more likely to be liquidated now. However, you had pointed out that the liquidation threshold could still stay high. So you were able to lower loan to value, but not affect me in a potential liquidation because the liquidation still stayed at a higher point. Can you explain that? Because I didn't realize that at first.
Yeah, absolutely. So the independent risk steward has proposed changes to the loan to value ratio parameters. And details of those are available in the change memos to be able to sort of go through and transparently understand sort of the reasoning and methodology for that. And this kind of, to answer your question, goes back to viewing the loan to value ratio and the liquidation threshold, the delta, as a buffer. Mm-hmm. And ultimately, the propensity for liquidation is strictly based on that liquidation threshold, which is the loan to value ratio increasing until that percentage is hit. And when looking through the lens of that independent risk steward and its justifications around lowering only the loan to value ratio, what that's effectively doing is increasing the delta between the amounts that can be, the percentage that can be borrowed and the point at which a liquidation takes place. So the delta itself, the buffer in itself, is a parameter. And there are optimal, there's an optimal buffer per asset between these two parameters that is to be optimized and implemented. But in terms of the precautionary measure of lowering loan to value, or the amount that can be borrowed against the collateral that's supplied, it doesn't increase the risk of the potential for liquidation for existing positions or even new positions in the protocol. What it does is only limit the borrow power for that collateral. So like you said, if it was 50 before and then lowered down to 40 or 30, that just says, hey, you can't borrow anymore past this LTV.
That makes total sense. Okay, because from a user perspective, you're actually saying, hey, Brian, you're taking out way too much. We're going to cap you. We're not going to cap you. We're going to lower loan to value because that particular asset fluctuates at a higher percentage. It's more volatile. So if the asset is more volatile, my value in my account can drop much faster. So if you lower how much I can take against it, I'm less likely to be liquidated, and you still have that higher liquidation threshold.
Yeah, and to that point, in terms of the independent risk stewards sort of setting these parameters, the buffer itself is an attribute of it is based on volatility. So normalized volatility over a long period of time, a month, 3 months, 6 months, et cetera. Essentially, that is what helps dictate the buffer between LTV and liquidation threshold.
Is this something that they'll be doing on an ongoing basis?
Yes, there'll be ongoing proposals that are made in terms of parameter changes based on dynamically changing market conditions. Market conditions are constantly changing, and so
Sure.
it's important to try to keep keep in line with those conditions. Let's say, for example, the secondary liquidity across centralized exchanges and decentralized exchanges for a certain asset goes up. There's more liquidity that is available. It might be in that circumstance that with enough period of time passing with that larger amount of secondary liquidity, that the parameters shift upwards because, hey, it's actually, we're in a place that can be a little bit safer to be able to raise that. And then the reverse as well. So lower based on if the liquidity concentration, et cetera, drops, then it would be an adjustment that's made in reverse. And it is really important to keep up with that. I think the important thing is doing so in a way that isn't sporadic, isn't
Sure.
just every minute something's changing, or every half day something's changing. It should be done in a way that kind of allows the protocol to continue to operate, and folks are sort of able to stay up to date with regards to these changes.
Regarding the ongoing auditing, how are those going to be implemented and take place?
Yeah, so this independent risk steward in the state that the protocol is in today is proposing these changes through a change memo. And that change memo is published in the documentation and available in the notification center within the protocol's sort of message center at the top.
Mm-hmm.
Give full transparency around justification for the changes, what the specific changes are, the implementation date of those changes, et cetera. That process lays a foundation for, and we'll use the same format of DAO proposals that get made in the protocol for these changes that are then voted upon by holders of the governance token of the protocol. And so
Perfect.
this matches the process that we see in Aave, Compound, et cetera, across other lending protocols and other ecosystems. And this is sort of the first phase of that, whereby the processes are implemented, and then they can transition to, once the DAO is live by the end of this year or very early next year, folks to be able to vote on those changes and their implementation.
Okay, that's great.
Yeah.
Regarding how the protocol works and whatnot, I think we covered everything. Was there anything you might want to talk about that I missed?
Yeah, there's one more parameter that I think is worth mentioning here. So in summary, we talked loan to value ratio, we talked liquidation threshold, the liquidation bonus or penalty, depending on how you're looking at it, supply caps, borrow caps. This final parameter is the what's called a reserve factor. And the reserve factor is a percentage of the fees that are generated by the protocol on a per asset basis that are generated from borrowers that end up going to the protocol's treasury to help support its continued operations in the ecosystem. So it's effectively protocol revenue. And each asset has its own reserve factor.
Okay.
And again, it's a percentage of the fees. So if you look at the USDC market, for example, and the borrowing that's taking place within the USDC market, borrowers are paying an APY on a continuous basis in order to borrow those funds.
Hmm.
And that APY is dictated based on how much is supplied in the protocol relative to how much is being borrowed, both on a global basis. So as more is borrowed of the total amount, the APYs go up for both suppliers of that asset and borrowers of that asset. And as it goes down, as the utilization of the pool goes down, those APYs also respectively decrease. And what reserve factor does is for the fees that are generated by borrowers and paid to creditors, the protocol takes a percentage. So for USDC, if it's 10%, that means that 10% of the fees end up going to the protocol itself.
Oh, that's interesting. It's actually a direct ratio to what the borrower is paying to what. So if it's a 9% I'm paying on that USDC, the Treasury takes 9% of that 9%.
Yes. Yeah,
Oh,
exactly.
interesting. Oh, okay. I didn't realize that's how it worked. That makes sense.
Yeah.
Okay. Lastly, let's talk about the future and vaults because I think that's fascinating. Some of the upcoming things. It seems like vaults is, if I'm not mistaken, your number one roadmap feature coming up.
Yeah, so Bonzo Finance Labs is, in continuing to contribute to the development of the protocol. The next phase of it is the implementation of these vaults. And vaults are smart contracts that automate the management of liquidity that is supplied to the vault. And the liquidity that is supplied is routed to various DeFi protocols across the ecosystem. One of the important ones that vaults will support is management of liquidity that is routed to Saucer Swap v2 pools. Saucer Swap is a Uniswap v3 fork, whereby in the way that it performs trading and exchange, it has concentrated liquidity. So folks supply a pair of assets to a Saucer Swap pool, maybe it's HBAR USDC, and then based on this mechanism of concentration of liquidity, the end user, when doing that action, would have to manage the ranges of concentration by which they supply. As prices fluctuate for that pool, they have to continue to actively monitor and manage those ranges and keep it concentrated in order for them to be able to sort of maximize the amount of yield that they generate for taking that action. The tighter the concentration they can get and the more actively that they manage that concentration as it moves, the more yield that they're able to generate. What vaults do is users can supply liquidity to a vault instead of directly to, again, in this example, a Saucer Swap liquidity pool. And the vault itself manages the concentration of liquidity for the user to try and help not only maximize yield for the user, but also keep liquidity in Saucer Swap for that pool within a range that allows it to be active and most efficient.
Hmm.
And this is a really important thing for I think, just the overall safety of the ecosystem is with Saucer Swap being a sort of the leading DEX, having those concentrations be actively maintained is really important to ensure that trading can take place against those pools in the most economically efficient way. And so the way I view vaults is it reduces overhead and management for the user supplying liquidity. It helps maximize the yield that the end user is able to achieve because it's actively managing that liquidity. And it also supports the ecosystem because it ensures that the liquidity that is in the Saucer Swap pool continues to remain optimally efficient so that trading can take place against it.
Okay, that's interesting. I was thinking of it just from one perspective, which was as a user, there's so many opportunities in DeFi, and most people on a daily basis don't have the time to go seek out what the next greatest one is, move some money over here, move some money over there, etc. These vaults will be created, like as you said, as a smart contract, such that it's going to determine how it's going to manage the money in that vault. And I will choose the vault, I guess, based on my own risk reward type ratio, put the money in, and then kind of set it and forget it, and know that it within those parameters, it's going to optimize my money as best possible, so I don't have to go do it.
Correct. So the example I gave is a sort of leading example for the usage of vaults that we see across the Web3 space. Vaults as sort of a product category isn't necessarily new, but it is a new development for the Hedera DeFi ecosystem. And so, concentrated liquidity management is one of those things for these, saucer swap V2 pools. But there are other strategies that can be employed by a vault, like you said, where they perform other types of automated actions with liquidity, which allow the user to determine that risk to reward and whether they want to supply liquidity for the vault to manage it for those strategies. Some of the strategies involve things like leverage liquid staking yield. So the ability to have the vault actively manage like the looping between a liquid staking token and a base asset, and effectively earn more yield based on the mechanism by which the vault is acting. There's an endless amount of strategies, and what's interesting with vaults is developers can come in, and it's a permissionless architecture. They can build and deploy strategies for the Hedera DeFi ecosystem and make them available to anybody who wants to utilize that strategy. The incentive for the developers is that any yield that's generated by the vault, a percentage of it goes to the vault developer and deployer, otherwise called like a strategist fee. So, we view vaults as, obviously of benefit to the ecosystem and users for a variety of reasons mentioned before. But it also opens up the door to more types of activities that the ecosystem and users can participate in.
That's interesting. Yeah, to your first point, but both of those are beneficial to me, the user. The first, you mentioned, hey, this is going to make a better balance of liquidity on the back end. That's going to help to make sure we've got proper trading on buy and sell side to keep prices a little more accurate. And then on the other side, you can bring in anyone can build one of these. Can you talk about if anyone can build one of these vaults and implement a particular strategy? What is the security behind that such that they don't take my money out of the vault?
Yeah, so the vaults that are made available are required to have an audit. So if the developer that is building and deploying the strategy, receiving an audit for that is critical for its ability to be exposed. And then for the vaults that are being initially built and deployed with Bonzo Finance Labs and also in partnership with other lab organizations, those will be audited and made available. And very similarly to like the lending protocol and the mechanisms by which it functions and the audits that take place, code is law in terms of the vaults mechanisms. All of the code bases for vaults that are made available are transparent and open source, so anybody can go and inspect the code base and understand its functionality. There's there's a sort of safety scores in addition within the UI that are displayed, which sort of give a sort of rough estimates with regards to sort of the perception of safety. And then, detailed information with regards to each vault, what protocols they interact with or they're managing the liquidity on, and various data points with regards to sort of the vault's behavior over time.
I think that's amazing. It's like having a money manager do this for you. So it seems to me that this would be a big deal. When do you think your first vaults might be actually implemented in live?
Yeah, timeline for vaults is looking like by the end of Q3, so end of September.
Oh, wow. That fast.
And yeah, and it's been in development for a bit of time now. You know, the first and foremost thing is just around safety and security. So, you know, as that's being assessed, as testing takes place, you know, a number of things that are prerequisites to pushing it live. Those things determine the timeline in which it's made available to the ecosystem. So, the estimate right now is by the end of Q3. Um, would always push that out in the case of not feeling fully confident with regards to the usability and sort of viability there.
Well, that pretty much wrapped up everything I wanted to talk about. Did we miss anything?
No, I think that covers it. You know, we had a great deep dive with regards to sort of all the parameters within the lending protocol. Talked a little bit about bolts. Um, you know, did the DAO as well, sort of that coming online by the end of this year, early next year.
That'd be great.
Yeah, yeah. So really excited for the future here, and also just seeing the DeFi ecosystem mature the way that it has. I think, you know, we've talked about this concept of DeFi 2.0 on Hedera, and I think a lot of these things, and not just that we're doing, but also advancements that are being made by Saucer Swap and H Suite and H Liquidity and Stater Labs, all of these different you know, participating protocols. They're really starting to push things forward for DeFi. So I'm really excited about that.
Yeah, yeah, you should be. Congratulations, you guys have done a great job. As and everyone you mentioned as well, the whole DeFi ecosystem there on Hedera has really been taking off, and it's great to see that. From what I see online, a lot of you seem to work together pretty closely as well, and I think that's important. And for those that are watching, there's I always follow that your X.com account. I know you've got a Discord, but there's the weekly Friday calls, which you've been doing for a while now, and then the weekly newsletters. So that transparency and communication has been really great. So, and thanks for doing this, because I think this really helps people better understand how it works, because you've been doing this for so long and you understand the technical side and the non-technical side. But for a lot of people that are just trying to learn about it, you know, it's great that you were able to walk us through every little step of how a borrow lend works. So thanks a lot. I really appreciate it.
Yeah, no problem at all. And really appreciate the opportunity to be able to come on and talk about these things. I think education is the most important thing, just enabling everyone to try and understand as deeply as possible how some of these things work. They can be, you know, obviously, as we've seen, pretty complex. And so, yeah, just see it as like a important initiative.
Yeah, absolutely. Well, thanks for your time. I appreciate it. And hopefully we can do another one of these in the future around new, maybe when the vaults come out.
That would be great. Yeah, looking forward
All
to
right.
it.
Thanks, Brady.
Thanks, Brian.
Thanks for joining us today. Visit Bonzo Finance to get started. And also, please take a look at my crypto school. I teach all things crypto and Web3. Have a great day.